Good after Good afternoon. I'm Chris Chelius with Option Ranger Group and Time Leverage Capital. Today is Thursday, April 10th, 2014. Welcome to Writing Puts for Premium Income, a flat to down market approach. Now an important disclosure. Please be aware that trading futures and options involves substantial risk of losses and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure and read to understand all disclosures before investing. All of the examples discussed are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, type them in the chat box and we'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He is the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends and All Markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage Time Leverage Capital and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. And without further delay, welcome to Writing Puts for Premium Income, a flat to upmarket approach.
Thank you, Chris. Today we are going to be doing a program on writing, selling, or granting puts using the basic Option Ranger software. We are going to review first of all how we go about this strategy, and first, as you know, in the market section you can go ahead and have a look and select a particular market. Today specifically we're looking at the energy markets and crude oil. So this will be a scenario for people that have an opinion about crude oil prices. And again, prior to trading on that opinion, one can go ahead and go directly to the market page to see the different contract specifications and trading details about the crude oil contract. There's a direct link to a chart, which is available in multiple time frames, as well as a what to watch list, which we consider to be important for people who are either examining the market for entry or monitoring the market for a current position. As you can see, we have both primary sources and secondary sources, and they have been compiled over many years in conjunction with the Dow Jones editorial team for the Dow Jones Megatrends letter, for which I was the chief strategist. And as you can see here, there are regular events that need to be monitored, such as weekly reports from the Department of Energy, the API, or American Petroleum Institute figures that come out, as well as monthly figures from OPEC, CFTC Commitment of Traders reports, which are very important, Energy Information Administration reports, and so on as you go down the list. Many of these are linked to primary sources where you can see the reports directly updated. So in this particular scenario, we are going to go ahead and presume that somebody, having read this information, looked at charts, or looked at a newsletter, has come up with a scenario that they believe in for the crude oil market. Specifically, on today's scenario, we are looking for an outlook that is bearish. So this person would be expecting, we are looking selling puts, so we are looking for a bullish scenario, pardon me, somebody's looking for a market that is going to go up, and they complement their view on direction with an expectation of diminishing or falling volatility. So in this particular case, the person is looking for an up market, or perhaps a flat market, or at the very best a market that doesn't drop in a big way or with rising volatility, but rather is firm, bullish, or flat with a diminishing or falling volatility. You can see the particulars of this trade at a glance here with a graphic of risk to reward parameters for the trade as a reminder for people that are already familiar with that outlook. And for those that are not, they can simply click on the image of what a short put of the short put graphic, and that particular click is going to bring them to a page which is going to show a detailed of the graphic with the specifications on the scenario when such a trade is contemplated, as well as a demo video on a scenario and some examples on how to input, monitor, and assess this trade. In general terms, selling a put is a directional trade. As we indicated, it is a bearish trade. You use it when you strongly believe that the market will go up or will not reach the strike price of the put that you sold at any time during the life of the option. So this is a market that's bullish or looking for a support, strong support at a certain level. As with all granting or writing of options, the profit is limited to the amount of the net collected from the sale of the option, and that obviously is the premium collected minus the transaction costs. Selling a put or shorting a put, as one might say it, is a margin trade, so the risk is unlimited. It is a margin risk, tick for tick. Once the put becomes intrinsic, the position does benefit from time decay, and it is a wasting asset. So for the buyer of this option, they are fighting against time erosion, and in our example, for the writer of the option, which is whom we are illustrating right now, time decay is an advantage. As time passes and volatility does not increase, which is one of our expectations, that option erodes and the seller of the option benefits from time decay. We have an additional, more detailed explanation here, complemented by the video, and of course for definitions and additional references you can go to our reference material sections and to our frequently asked questions and guides section. Right now, let's go ahead now. We have an outlook that we've indicated. We're looking for a market that's going to hold at a certain level or rally, and let's look at some examples on the crude oil market where we can put pencil and paper or a spreadsheet, if you will, to those examples. We are doing, again, examples on crude oil selling puts on the June contract. We have a reminder on the tab that the direction is up, the volatility outlook is down, and we do remind people that this is a margin trade, as are all short option trades, unless covered. Let's go to our first example, and we're going to do 3 examples. We're going to do an example of an out-of-the-money put option. We're going to do an example of a closer to the money or almost at the money put option, and also for an in-the-money put option. As you can see, the farther out of the puts, money puts are trading for a lower premium, closer to the money trades for a higher premium, and the in-the-money option trades for the highest premium because it has an intrinsic value. And we will do this. We have extensive information on those classes of options, both in our reference material section and among our demo videos. Let's now go to the first example, and the first example that we are seeing here is the sale, and this is the highest premium collected, so this would be the most bullish trade of the 3, if you will. This is the sale of an in-the-money put with a strike price of 103. What makes it in the money is that the market is at 102.35. So the put is already above the market and intrinsic at current prices, shall we say 65 points or $650. As you can see, when you select the trade to sell a put, if you are still learning about these types of trades, you get a graphic reminder that gives you the key ingredients of the trade. First of all, the different time decay factors over different time frames, which are described in the legend, along with a reminder that if you've input this trade, the scenario that you're looking for is one in which direction is up and volatility is down. So if somebody inputs this trade, puts in sell a put, and they get these particulars up, and they realize that they're expecting rising volatility rather than diminishing volatility, that person would realize that they've input the wrong trade, and that is not their scenario. So now, as you can see, once we click on the trade, we get the dialog box. Once we click on the market, you get a contract spec box which also takes you to the earlier contract specifications that we had, which are just one click away. The strike price that is selected, when you click on the strike price box, and these trades have already been input, you get an example of how to input the trade, and again, just one click away, a discussion of how strike prices are treated and the different categories of options. Then we get an example of how to input premium so that we know how to illustrate the prices of the trade correctly, and again, as according to the design of the Option Ranger, there's, again, in addition to the quick dialog box, there's just one click to an additional discussion of premium and how premium is determined. And then, of course, we input the costs so that the numbers that are generated are numbers that are generated net of costs and give you an actual clear view of what the position would achieve with the costs factored in. So as you can see on this scenario, we have a summary, basically 3 summary boxes that pop up once you put in this particular transaction of selling a put. The first summary box gives you the contract specs on this selling a put strategy, which is that there's one crude oil put sold at 103 for a premium of 2.4, and that the gross premium collected is $2,400. So these premium points get translated into dollars and cents. Then the next box takes us through the deduction of transaction costs so we can come up with the number of the net premium that was collected, which is $23.45 after costs. And as you will recall from the particulars that are discussed in the selling a put section, the maximum gain on the trade is limited to the net premium that is collected. And as you can see here, that is exactly the case here. The net credit is $23.45 and the maximum profit is $23.45. This is always the case when you sell an option. The most that you can make is the premium collected after transaction costs. The $23.45, for purposes of tracking the position in premium, is also listed as a premium here of 2.35, rounding up, so that you know that if you can buy this option back for less than what you paid for it, then you collected, then you're making money, and that if you need to buy it back for more than you collected on it, then there would be a loss, and this is the premium break-even to monitor throughout the day. We have extensive discussions of how this premium is comprised of in-the-money value or strictly volatility and time value that is available both through other webinars and in our reference section. In addition to tracking the premium on a regular basis, a person who writes an option or trades in a market should have a sense of where their break-even is on the instrument. So in this particular scenario, this trade intrinsically would break even, or at expiration, if you will break even, as long as the market is above 100.66. Because again, although the put that was sold was a 103 put, the break-even has to take into account the money that was collected, so the position does not actually incur losses intrinsically until that credit, the money that was collected to do the trade, is exhausted or is erased by larger drops in the market. So as we can see here, because again this is a margin trade, once the market drops below its drops either below the break-even instrument point or rallies above the premium break-even point, there's a loss of $10 per tick on that move, and that move can go as far as the market will go. So now let's look at the particulars intrinsically of where this trade works. As you can see, the seller of this option is hoping that the market will end up at 103 or above, in which case the maximum gain of 23.45 is made. And again, no matter how far up this market goes, that 23.45 is the maximum that the seller of this put option can make on this transaction. On the other hand, once the market breaks under the break-even level of 100.66, as you can see here, the losses begin to go $10 a tick, $10 a tick, and anybody who thinks that there could be a drop with rising volatility, which is exactly the opposite outlook, would not do this trade because, as you can see, on a significant drop, the loss tick per tick can accrue pretty well. So the seller of this put has to be fairly confident that the market will go up or stay flat, or at the very least not drop with rising volatility. In this particular scenario, as we can see, there's some margin of error, but let's say, for instance, somebody says, well, you know, what if the market drops? I may need, I think support might be a little bit lower. That's too much. So let's say a person in that scenario might go, well, let me go slightly out of the money to another strike down and sell the 102 put, which is now turning over the right to taking on the obligation to be long at 102, which a bullish person you think might want to do. Again, all the fields are populated, and now the summary box looks different. The net collected on a 102, the gross premium collected is 1.92, and at $1,000 a barrel, that's $1,920 is the total. Minus cost comes out to $1,865, and that gets translated to premium points. So we have a premium break-even for daily monitoring and a futures break-even at 100.14. As you can see, unlike the previous scenario where the break-even was at 100.66, this break-even now is at 100.14, and although the person is collecting less money than in the previous scenario and has a smaller maximum profit gain potential, the person also has a break-even which gives them an additional cushion of almost 50 points to drop, and then the spreadsheet, as you can see, will look different. Again, the maximum of 1865 will be gained at expiration at above 102. Then there is a margin of error below 102 based on the premium collected. So now, although the market could be at, in fact, we have a market around 102.35, so even if there's a drop, so we say near to 101, the bullish outlook would have been mistaken, but the diminishing volatility outlook would be sufficient to turn the trade into a winner even on a drop because the market did not drop fast enough. Likewise, at 100.56, which is about 180 points away from the market, again, although the market, that's a fairly decent drop, $1.80 away, there can still be a net at expiration because the volatility of the drop is not as great as is currently factored in. So a person could be wrong on the direction but be salvaged on the trade by a correct outlook of diminishing volatility. Of course, if the outlook of diminishing volatility is mistaken, as we've indicated before, the losses can be tick for tick, and anybody who contemplates or can imagine a scenario of extreme rising volatility that would make these levels of loss and margin loss unacceptable, and again, it's unlimited tick for tick below 100.14 intrinsically, would have to take this trade off the table regardless of how strongly they feel about the bullishness of the market or their belief in diminishing volatility. Finally, another play on this particular market is to sell what would be an out-of-the-money option, a farther out-of-the-money option with a strike price of 96. In this particular case, that would be $7 and about 35 cents away from where the crude market is currently trading. So there is a significant, if a person believes it, there's strong support at 96 or above. There's a significant margin of error, as we will see before this trade would intrinsically go negative. Of course, in exchange for having that larger margin of error on a drop, the seller of this option is collecting significantly less money. So the risk to reward scenario has shifted. The intrinsic risk, the tick-for-tick risk, is moved farther out of the money, but in exchange for reducing that element of risk or moving it farther away, the writer of this option is receiving a smaller premium because arguably it'll take a larger event in order for their contingency to be met and for this position to be intrinsic. So as you can see here now, this collector of premium has collected $400 or a net of $345. The break-even on premium is 34. So again, in this particular scenario, that's the most that one can make, which is $345. The premium break-even should be monitored continuously, but as you can see now, although there's significantly less money collected than in the other two examples, the break-even on futures now is at 95.66. So the person is taking a smaller amount up front to take the risk of the margin on this contract, taking significantly less, but in the case of the 103, they start to lose tick for tick under 100.66 or above this premium level. In the scenario of selling a 102, they are intrinsically tick for tick losing money at 100.14 or above 186 if they have to offset the option. So both these numbers are somewhat above $100 a barrel, but on this scenario, where the person collects less money and has a smaller profit potential, they also have an intrinsic break-even on the instrument itself at 95.66. So this person would be safe on a move that would be larger in exchange for taking less money and assuming that risk at that different level. Again, we have all the contract specs, the maximum that can be made, and the tick-for-tick loss intrinsically below 95.66 or on premium above 34 ticks, where it would be a tick-for-tick loss of $10 a tick. And here, when we see the trade again, the goals are much more modest. Person would make a max of 345, and again, even if the market goes down and this person's directional outlook is mistaken. So this is a bearish trade, and yet, as you can see, the person can make their maximum gain even if the market gets down to 96, which, as we indicated before, is a change of approximately $7.35 from the current price on April 10th, which is at 102.35 at the moment. So even on a significant drop to 96, if it is not with sufficient rising volatility, the writer of this option can keep all that premium. So this person is looking for a significant margin of error, willing to take a small premium in return, with the understanding, however, that if an unexpected large drop happens, and it is contrary to the assumption, one with significantly rising volatility, in exchange for that limited amount of profit, there can be a tick-for-tick loss that becomes pretty significant on a drop. As you can see, even at a 94 level or thereabouts, this trade is down 15.55, and as it continues to drop, and you can expand the rows to see it's actually a steady number because there are strictly steps based on the tick values involved, and as you can see, on a bigger drop, the risk becomes even bigger. So somebody who writes this put on the one hand would have to feel bullish and believe in diminishing volatility, and if they have any notion that this market could take a big drop, they should be very mindful of the steps and the continuing loss for tick below that intrinsic level that is listed. So these would be three different ways for people to be bullish this market with expectations of diminishing volatility, And again, in doing so, it is very important, since it's a margin trade, for one to examine the worst case scenario or the large drop scenario, which, although not the expectation of the trade, must still be taken into account when assuming the risks as well as contemplating the profits that could be achieved. Chris, do we have any questions from any of our folks that have been posted?
There is one question, Mr. Mueller. Let's say that you purchased an option. You sold an option, sold a put, and the market increased in volatility against your position. What steps could you take to offset that position besides just purchasing back the option?
Well, the first example you gave, which is the simple example, is sometimes the best example, which is sometimes if a trade is no good or you change your mind about the trade, you can offset the trade. And various trading disciplines can be established to do that. You can set an alert in the futures and say, let's say if you see that the market is dropping to 97.5 within a certain time frame, although at expiration intrinsically that would still be a level at which the maximum can be gained, it might make one think about whether they have changed their mind about direction. So if you get a quick drop with rising volatility, you have to see where you are relative to the strike price and intrinsic value, and make the determination if you think that the volatility is going to keep being strong and the drop continues. If so, the likeliest thing to do is to offset the trade because the premise was wrong. And if the outlook changes, the easiest thing to do is just to reverse opinion. If the person's opinion changes in this particular scenario and they think, well, there's going to be a drop now and it's with rising volatility and I think it's going to continue. Well, one thing to do is to offset a trade, and there's another, which is to initiate a trade, which would be one that would expect a drop with rising volatility. The simplest way to do that perhaps would be to, if the view changes to the opposite view, is simply to reverse the trade. If you sold a put because you're looking for an up market with shrinking volatility and you've got now a down market with rising volatility, first of all, you offset the trade about which you've changed your mind. And secondly, you can add a trade that has the opposite outlook, which is for a drop with rising volatility. And that could be just as simple as buying another put. So one could turn around. Let's say the market for some reason makes a volatile drop to 97, and the outlook has changed completely. What you can do is, instead of just buying back the 96 put that was sold, one can buy two of them, one to close and one to open, because buying a put is the opposite of selling a put. So if the opposite outlook has emerged, then what does is one gets bearish the market with an expectation of rising volatility, and that would entail buying a put. And whether it would be the same put that was initially sold and offset, or whether it would be a different strike price, would be a function of doing the same types of tests and analysis on the different strike prices on purchasing a put that we have done here on selling a put. Moreover, if somebody thinks that they just want the margin of error, they might roll that put down. So let's say they think the volatility is up, but the direction continues down, is going to be down now, but with undecided volatility, then they can just roll that put down and try to preserve their initial credit before another leg down occurs. The important thing is that we are, as you can see, when we monitor these trades, we always have follow-up strategies that we can monitor, and we always do it by going back to having an outlook on the market. So in a scenario where we are short a put because we were initially bullish with an expectation of falling volatility, if our expectation changes to a market that is bearish with rising volatility, which is the opposite of the initial outlook, then certainly one adjustment is a long put, and that could be the offset of the first position. And it could be the addition of a position if one has entirely reversed opinion. And that's very important because people can't get married to a trade once the assumptions and premises of that trade have not been borne out. The person has to really reconsider and go back to their scenario and make sure that they still have the same expectation and that they're not just holding on to a position out of stubbornness or indecisiveness. So again, if let's say, for instance, somebody in that scenario says they're bearish but they have an undecided volatility outlook, then they might go ahead and maybe offset the one position at a bear put spread, maybe just roll down that put, and of course they can also convert the position into a butterfly if they want to have a no margin covered position with some additional premium collected. And as we go through the strategy gallery, every time something changes, we can go to a follow-up strategy in the strategy gallery so that as the scenario changes, we can take the existing position and adjust it into a position that is consistent with the outlook or the new outlook of the trader. Okay, I hope that answers the question. Is there a follow-up?
No, that's the only question.
Okay, it's an excellent question. Thank you all for attending. Again, when you sell puts, you can have a significant margin of error. However, do bear in mind that it's a margin trade, so in exchange for the limited potential of the net premium collected, you have to be mindful that you have the cushion and the risk tolerance to do this as a margin trade. Thanks again for attending. Learn as much as you can about the markets before you put your money on the line, and I look forward to our next program.
Thank you, Mr. Mueller.